All right, hello everyone. Thanks for attending. It's been a short while since we have this joint webinar between myself and Ms. Maureen McCann. My name is Seewing Yi from the Yi Real Estate Network, and my special guest once again is Maureen McCann with Spartan Invest. In terms of briefly, our company's background, we are physically based here in the San Francisco Bay Area for the past 20 years. And for the past 20 years, we have helped out-of-state investors, regardless of where you live in any part of the country or even the world for that matter, we help you to buy out-of-state turnkey remote sight unseen passive investing, and using a turnkey one-stop shop approach to property management. We have like almost 10 different real estate markets. We help investors to buy investment homes. And again, my special guest, Maureen, her company, Spartan Invest, are one of the top turnkey real estate investment provider in the country, and they cover a wide span of a market, mainly in Alabama, Tennessee, and northern Georgia. So they have a tremendous investment business model methodology and one-stop shop, and they have been providing great service, great cash flow properties, very low cost in up and coming market in that region of the country. So without further ado, Maureen, thank you for your attending once again. Thank you for your time. And our goal in today's webinar is to take a step back and re-educate real estate investors. What's going on? We can dispel all the inaccurate information from the negative news media. We can dispel all the misleading information coming from the YouTube videos about all the doom and gloom, all these negative headlines you've seen out there. We're just gonna become as transparent as possible to give you the pure real estate and economic data so you can become a confident real estate investor, so you can take action in this very opportunistic environment. Is challenging. However, if you digest the information we're going to share with you, you are very inspired to take action and to create real estate wealth for yourself and your family. Am I right, Maureen?
We have lots to talk about today, Seewing. So let's jump in. It's a pleasure to be here. Thank you.
Absolutely. Let's get right to it. So let me share the screen. And here we go. All right. So right now we are seeing in terms of real estate is a high demand. Yes, there has been a little bit of decreased demand due to higher interest rate and people taking a pause from buying at least temporarily. But right now we're moving into the summer season and what have you. But we feel the high demand will continue beyond this year, and we'll talk more about that, especially for millennials. So still very high demand. And we still have very, very low supply of homes, still a historical low, believe it or not. In some credible sources, as you can see, America is short more than 5 million homes, and builders can't make up the difference. So we are seeing huge disparities still, right? We're in the middle of 2022, low supply of homes, still relatively strong demand. And so that's what's happening. All right. And then when will housing inventory return to 1.5 million that we need? Look at this. You know, this year, regardless of what you hear out there in the news, we still have very, very big disparity between supply and demand of homes. It is still a seller's market. And depending on what market you're talking about, by the way, every real estate market is local, is different. So is no such thing as a national real estate market. So every region, every city, every neighborhood for that matter is very, very different. All right. So with that in mind, so the question is, the big $1 million question is that when will housing inventory will equal the demand and supply equilibrium, become a normal market, if you will? Well, not in 2022 for sure. In 2023, the projection is that there will be on the supply side. The supply side is potentially slowly catching up with the demand side for next year, 2023, at the rate of 36%. Then 2024, the supply side of housing will continue to catch up with demand to the tune of almost 38%. So therefore, this is just projection from this credible source here. However, from Zillow price expectation. So not until like 3, 4, 5 years from now, before there's a balanced market of 5 to 6 months of supply versus demand to create a normal market. So what does that mean? That means based on projections, the housing prices nationwide should have a positive increase. Some say 5% appreciation rate for the rest of this year. Some say 7%, some say 8%. Bear in mind that that's what's happening, right? So the people who take action this year, they will expect to receive, obtain higher housing price increase, right? And then because the home affordability is at a 40-year low, this means that more and more primary home buyers are being priced out of the market because of skyrocketing home price increases in the past couple of years. As a result, many people are staying off the sideline. Many primary home buyers cannot qualify to buy more due to a higher interest rate, and they have to rent because there are so many people renting. There are bidding wars for renters in many markets in the U.S. And I'm just giving you a sample. For example, in the Sun Belt in Florida, for example, and in Texas, there are some massive rental increases. Look at 55% from the last year to this year, and 32%. I mean, just triple-digit, double-digit rental rate increases. And that will bode well for risk investors because they will get more cash flow, even though currently the cash flow may not be as high as we would like. So we will talk about that. All right. And speaking of skyrocketing home prices, here are the top 10 states with home prices increases from the past 12 to 18 months, with Florida leading the charge, then Arizona, then Tennessee and Nevada and a few other places. But coincidentally, Spartan Invest are heavily penetrating the market in Tennessee, in Chattanooga, for example, and that market has achieved double-digit appreciation year over year. So it's a good sign that Maureen and her company, Spartan Invest, are in the right market. So it's an up-and-coming market, Tennessee, and of course Alabama as well. We'll talk more about that later. Right. So again, so many people are freaking out, right? Just because today's rate is anywhere from 5.5% to 6%. People think it's gonna be a crash. It's gonna be a recession. I don't know about that, because even at today's rate of 5.5% to 6%, is still a historical low interest rate. Is that amazing? So people have this recency bias. It's just I know last year it's a historical interest rate like 3%, 3.5%, shot up to all the way to 5.5% to 6%. People are freaking out. But you look at the back in 1980s, the mortgage interest rate were as high as 18%, right? So only in the past 10 to 15 years or so, the interest rate were below 4%. Look at the year 2000, 20 years ago, is like 6 to 7% interest rate. Back in 1990s, 8%. So so we have to look at history in perspective. Again, the rates are still low. If you can see the chart, right? Look at the 1980s, 18% interest rate. Right now is only 5.5% to 6%. So I wouldn't panic if I were you. I wouldn't freak out if I were you. It's just that's what's happening. And then, in fact, Maureen going to talk about this a little bit, but let me start by saying right now inflation is at a historical high in the past 40 years. highest inflation. Now, the government official estimation of the inflation is, I think the last time I checked recently, was around 8.5% inflation rate. But you and I know, right? If you go shopping for groceries, for airline tickets, or for eating out, whatever, the inflation rate is way more than 8.5%. And some people may argue it's at 12 to 15% even. Now, one thing I'm going to say that a lot of you out there may not have heard, but you may have heard from the first time, and Maureen can talk about it momentarily. Think about it. If the official rate of inflation right now is 8.5%, and if you buy an investment property and you pay a 30-year fixed rate mortgage of 5.5 to 6%, look at the disparity. What does this mean? I'll say it again before Maureen will chime in. Today's official inflation rate is 8.5%, and the mortgage interest rate you're paying is 5.5 to 6%. What does that mean to you as a real estate investor? So with that in mind, Maureen, take it away. What is your perspective on this?
Well, thank you. So, gosh, you've got lots of good slides here, really good data, and you and I are on the same wavelength here without even conferring before this phone call or before this Zoom call. So, yes, what that means for those investors that are listening is that while the inflationary rate remains higher than the interest rate on borrowed money, you are essentially being paid to borrow. You are earning on the borrowing side. So think about it this way. You lock in for, and I want to rewind just a little bit. So when you showed the slide, Seewing, of the historical interest rates dating back to the 1980s, we are historically low. But we have been, a lot of us investors have been very spoiled. We've been very spoiled because we have, we've had interest rates below 5% and many times below 4%. So when you can lock in, and many of these listeners probably have refinanced their primaries into rates of 2%, right? So when you get the benefit of taking borrowed money and locking it in for a fixed payment over a fixed period of time, that is beneficial to you. As investors, when we do the same thing, we take that borrowed money, fixed payment over a fixed rate period of time, and then you add in depreciation of the asset, increases in rent. Of course, you get the depreciation each year on your tax schedule. You get the hedge against inflation, which is what we really need to talk about here. When you add those benefits all together, real estate has been a tried and true and very inflation-proof asset. So a lot of, I will say this from selling turnkey rental properties for the last 13 years, is we've always just shouted from the rooftops, cash flow, cash flow, cash flow, cash flow, cash flow. You invest for cash flow. That has been true and still remains true, but we have to look at what has changed here recently. And it all started in March of 2020 when the printing presses for money went nuts. 40% of the current monetary units in circulation today have been printed since March of 2020. In 2 years, 40% of the money supply in the United States has been printed in 2 years. The true definition of inflation is not the CPI, right? Because the CPI is, in my opinion, it is a manipulated metric to make things look better than they are from a government's perspective. They basically take, here's a basket of goods, they cherry pick what they put in that basket, and they say, okay, this is what the consumer price index is, and that's what the inflationary rate is based off of. Now, I don't know about you, Seewing, but I think your basket of goods and my basket of goods and your neighbors and our friends and family, everyone has a different basket of goods. There's some overlap, but you're not getting your nails done and your toes done, right? You're not going and getting your hair colored every 2 weeks like I am, right? So there's differences in that metric, and it's very manipulated by the US government. So the true definition of inflation, if you actually look it up and you go to a dictionary from 20 years ago and you look up Webster's Dictionary of Inflation, it will tell you that inflation is a change in the money supply. What has the government, our US government, not only US, what have many other countries and their governments have done? They've just printed more money. So now we find ourselves in this situation as investors, and we have to figure out where is the best place to place our capital right now in a highly inflationary state, which looks like it's going to continue. And you make a very, very good point. If inflation is at, as the government reports, which we take that with 100% accuracy, at 8.5%, and you're borrowing money at 6%, let's call it, you are essentially getting paid to borrow money. Now, guess what? Here's even a beautiful, better thing, right? If you're paying, let's say you're paying 6%. I'll even go a little higher and say you're paying 7% by the end of the year, right, for borrowed money. When you factor in the depreciation benefit that you get, it's really like paying 5% money, right? But we've all been so spoiled for the last 10 years of paying under 5% that people are freaking out. The fundamentals do not change. The fundamentals are you want, so the fundamentals don't change, which is buy appreciating assets that cash flow and reduce your tax liability. That is the formula for building wealth. Slow and steady wins the race. Real estate has been tried and true for centuries. This is not just, our little short timeline here on earth that we're saying this works. It has been proven long before we even arrived here on this planet. So the fundamentals do not change. What has changed and where we have to pivot in our thinking as investors is the days of buying a $150,000 house that's going to cash flow $300 to $500 a month does not exist today, right? What does exist today are renovated properties, brand new construction, where you can buy for under $200,000 in, actually I would say most of my properties are under 200,000, but my new construction goes from 230 to 250. So let's call it under 300,000. You can still buy a brand new house, a renovated house, lock it in at a rate less than inflation. And it's an asset that appreciates along with inflation. When you add in the rent escalation over that fixed rate period of time, right? Your mortgage payment never changes for that 30 years. And most real estate investors, they hold their rental properties from anywhere from 5 to 30 years. During that time period, you are going to have rent escalation over that time period coupled with the appreciation of the asset. Now, Seewing mentioned that there are various groups, housing analysts, investment strategists that forecast what the capital appreciation, home equity, will be in the coming years, and it's based off of just basic economics, supply and demand. We don't have enough supply, there's a very high demand. Are we going to see the record double-digit capital appreciation? I use capital appreciation and equity interchangeably, if anyone's getting confused. We've seen exceptional capital appreciation over the last 224 months. We probably won't see that same double digit, but we're still going to see incrementally year after year until we capital appreciation increases until we get to the equilibrium that Seewing was talking about. So let's just say you guys have I'm going to cheat, use my calculator, right? So let's say you invest in a $200,000 house today, you finance at 6%, and maybe you don't get the $250 a month cash flow, maybe you get $100 cash flow. But that's after all the expenses are paid, it still does cash flow, right? And the formula for building wealth is buy appreciating assets that cash flow and reduce your tax liability. So it still works. Even in a higher interest rate environment, it still works. So you take that $200,000 property, and let's just say, I'll go with Pulsenomics' recent forecast for housing value appreciation of 9%. So I'll take that $200,000 property and multiply it by 9%. That comes out to $18,000. If you had multiplied that by 5 properties, right? That's almost $100,000 that shows up just by you holding the asset that is a high value asset because it is a scarce asset at the moment, right? So lots of bullet points there, Seewing, that I just sort of unraveled. But I think what you were really asking me is, what is the benefit to investors today in investing in hard assets like real estate? And many investors are looking, we're all, I mean, myself included, we're searching. It's like, you know, I've got money in the stock market, and I've seen a pretty significant reduction, right? In that, because I'm an aggressive investor. So I saw a significant reduction in my portfolio. Worrisome, but luckily I've got a lot of properties that I own. So when investors are looking at this particular moment in time, in July of 2022, and they're looking at, what do I do for the next 6 months, for the next year? Where do I put my money? Because the market is very volatile. Crypto is very volatile. Bond market is very volatile. Where can I put my money in a place that is a good hedge against inflation, or an inflation proof that will still produce cash flow and reduce my tax liability, even if I'm paying a little bit more for the borrowing cost to buy that asset, it's still well below inflation. And so there's definitely a benefit, a real significant benefit for us as real estate investors.
Very well said, Maureen. As a matter of fact, in the latter part of our presentation, we're going to break down those data you just mentioned. We can talk about on a numerical basis. I'm going to show some graph of all those numbers, and you'll see it. You know, your verbal presentation will be validated by my graph, and the numbers will show. And so, you know, it'll come together for a lot of you out there that are listening to this very important, highly educational presentation. So thank you for your nice recap. So keep your thought. Let me continue my presentation, and yeah, a lot of things. All right. Okay, now let's quickly go over a couple of things. Again, for risk investors, for long-term risk investors, in the past, who knows, in the past 60, 70, 100 years, if you invest for the long term, right, in buying real estate, you will make money. Your property will increase in value. There's only one exception in the past century that real estate prices had gone down, and that was in the 2008 real estate market crash, right? As you can see the graph, right? So, you know, it's so simple. You know, I mean, what is there to fear, right? Than to fear itself. If you invest for long term, over the past almost 100 years, only one time the real estate has crashed back in 2008, and only the reason that happened was because of the subprime mortgages, because there were oversupply of homes. Anybody can qualify to buy properties and all that scenario. And by the way, that's a subject for another video presentation. But in today's real estate world, we're not seeing any of those trends that caused the 2008 market to crash. So just take that with a grain of salt, right? So today is a whole different market. I mean, and this slide shows over the many decades, even through recessions, again, with the sole exception of 2008 crash, real estate has maintained value throughout all the various recessionary cycles over time. So just go to show you, real estate is very resilient. All right, so as a real estate investor, I could make the argument, and Maureen as well, is right now, I'm not talking about tomorrow, next week, or next waiting. The cost of waiting will be very catastrophic for real estate investors. Right now, I truly believe what I will, and Maureen as well, and that is the best time to buy real estate, best time to invest in real estate, because it's a renter's nation. Like, as I said earlier, not only does the real estate prices have skyrocketed in the past couple of years, and even in the past 10 years for that matter, but the rental increases, this single digit, double digit, triple digit rental rate increases is coming. You're not seeing the impact of the rising rent yet, because the rental increases lag behind the rental appreciation rates. All right, Maureen, I'm sure if you want to chime in, you can. But right now, the pro forma I'm about to show you momentarily may not reflect that. But get in the game, buy your properties at your earliest convenience. Then in the next year, next quarter, or later this year to early next year, whether you have the same tenant they're occupying your property or not, or you can have a next tenant in, that the skyrocketing rent will reflect on your property, right? You can raise the rent for 10, 50%, whatever, depending on what neighborhood, what market you're buying. I'm not saying all the market are the same, but as a landlord, as a real estate investor, this inflationary period that we're facing right now, with all those challenges that we're facing, is really good for the real estate investors, because inflationary times, you're getting rental rates rising because people are renting these days, right? Today's a renter's nation. I mean, we're not going to sugarcoat it. Right now, moving forward for next several decades, I believe that there will be more renters than ever in the history of the modern U.S. Economy. There are more renters than ever. So people, there are some market where you're seeing 40 to 60 rental applications per house that are marketed for rent. Just go to show you. Before, you hear the buzzword bidding war for buying houses in the past couple of years. Now, now you can hear bidding war for renting your houses. So that bodes well for real estate investors. Your cap rate, your rental income, your cash flow will increase starting very, very soon. May not be now, like I said. So just keep that in mind, okay? All right. So any quick comment, Maureen, you have before we'll go over a case study of?
Yeah, no, that was a really great point. The beautiful thing about owning rental properties is you as the landlord can control the rent increases, right? So you can hedge. Not only you're hedging your bet against inflation with the capital appreciation in the property, but you have control over what you increase your rent by year over year. And each time, renters are expectant of that. If you're in a year lease, the expectation is that lease is going to go up a certain percentage each year. So when you are in high inflationary times, you're looking for ways to beat inflation and still get the cash flow. You want to have more control, and being a landlord and being able to increase the rent gives you that control.
Yeah, Maureen, you and I agree. Not only new investors buying your rental properties moving forward right now, but on my own personal real estate portfolio, and I'm sure on yours, Maureen, as well, and many of our past real estate investors that purchased 5, 10, 15 years ago, you know what they told me? They are increasing their rents. They are getting more cash flow than they have in the past. So their cap rates on their homes, rental homes, is like a 6, 7, 8% cap rate, very high cash flow. So the cash flow will come slowly but steady in the next few years. Right now, you may not experience it, but you will very, very soon. All right, so with that in mind, now this presentation, the second module we're going to discuss, Maureen, we're going to use a case study of your current property within your own portal. As a matter of fact, in Tuscaloosa, Alabama, this property is $230,000. Now, let me tell you, now on the face value, when you look at the numbers, as a risk investor, especially newbies out there, you're thinking, oh, this is not going to meet my expectation. Hold your thought. Experienced investors, I think you know what I'm going to talk about. And Maureen just went through over that. There are more than one way. Creating wealth through real estate is not only about cash flow or lack of it. Now, the face value of this great value new construction home in Tuscaloosa, Alabama is still on the portal, Maureen. I'm using this as an example. I know this is an example of a $230,000 new build single family home in Tuscaloosa, Alabama. We can make the argument, what I'm about to show you, the numbers I'm about to show you does not, don't worry about the 230K. I could talk about the presentation as if this is a $100,000 property or $150,000 property or $275,000 or even $350,000 property. The concept is the same, all right? What I'm about to explain to you applies to cash flow properties within this price range. So even though I decided to choose this $230,000 property as a case study, right? Now, you look at it, briefly look at the numbers. Purchase price $230K, very good new build. New. It's such a. We're not gonna spend too much time on a new build. There's so much value a new build has on other, older properties. Even though the older properties is just as good if it has been, renovated properly and make it in a turnkey status like the one Spartan Invest has been promoting. In addition, the resales, the older resales, and the new builds that Spartan Invest has is just amazing. So you look at numbers, initially you're thinking, okay, I'm putting 25% down payment, I'm paying almost 6% interest rate or 5.5% interest rate on this. My total out of pocket is $61,000. Okay, that's fine. And then you look at the monthly rent. I'm only getting around $1,300 monthly gross rent to buy a $230,000 property. I mean, this is not a good deal. Hold your thought, Maureen, right? Many investors, especially the newbies out there, you look at the pro forma of a first year projection. I know pro forma is just, I know is an initial evaluation of a property, but it's way beyond the first year projection. Okay, with that said, let's talk about first year projection. Even at this $1,300 monthly rent, which by the way, I'm sure Maureen gonna say, oh, this $1,300 is a very conservative figure, and the rent will increase based on what I just said, right, about what's going on with the rental increases and what have you. So it's gonna be a much higher than $1,300 down the road, right? But this is just just a projection, and then you're thinking, wow, the rent to value ratio really does not make sense. The cap rate is only like 5%. It doesn't make sense. Hold your thought, okay? Just be patient what I'm about to say. Now, in this particular market in Alabama, look at the property tax rate on an annual basis. $1,100 annual property taxes. That's like half. What is it? That's like less than half of 1% property tax rate. If you buy a property in Texas, for example, the property tax rate could be as high as 3% of the purchase price. Think about that. In Alabama, your property tax rate is half of 1%. This is shockingly impressive, Maureen. I don't know why Alabama, the property tax rate is so low. That's why this projection, this property evaluation based on a savvy investor like myself and you, Maureen, it still makes sense. Hold your thought, right? So it creates better cash flow because the property tax rate is so low. Briefly, Maureen, can you share with the audience why the property tax rate in Alabama is so low?
Yeah, it's very easy. So every state they have to fund the police, fund their schools, fund the infrastructure, right? So they find a variety of ways to tax us citizens living in that particular state to get those revenues to maintain the state. as they need to. So the beautiful thing about Alabama is they get the majority of their tax revenue from sales tax. So, it's like, you can look at you can break down all these different states. Some have very low property taxes, some have very high property taxes, but the high property taxes might have low sales tax, right? So with Alabama, we just benefit because they get the state gets the majority of their tax revenue from sales tax and income tax, right? So we benefit just from the low property taxes. They haven't changed that, so that's what makes it work so well.
Yep, I agree. All right, so let me continue. Very good explanation. Thank you for the clarification. So let's do the pro forma. Let's go with the monthly. $1,300 gross rent minus taxes, monthly $92, insurance $43, and property management fee of 10%. I believe it's 10%. And then, yes, look, as a primary home buyers, investors, listen closely. A primary home buyers, someone is buying owner-occupied properties, right? Or a first-time home buyers, right? When people buy a home to live, they buy based on the payment, based on the monthly payments, principal and taxes, right? Mm-hmm. And therefore, the interest rate affects a primary owner-occupied buyers. That is their criteria to make this important decision, right, Maureen?
Yes.
Now, as a real estate investor, you do not buy based on interest rate. You buy based on the numerical analysis and the positive cash flow and all the other numerical metrics, which I am sharing with you. You just noticed, right? Even at 5.5% projection interest rate for investor rate on this particular pro forma, and the payment is monthly payment is $979, right? This $979 is part of the debt obligation, is part of under your expenses, right? See, I say it again. The $1,000 mortgage payment you're paying to buy this investment property as an investor is buried inside the expense calculation. Is not a primary driver for your decision making. Your decision making as a risk investor, you have to look at the potential monthly gross rent at 20 to 25% down payment minus all the debt obligations. In this case, the numbers or your mortgage payment $979, right? And your taxes, insurance, property management fee, and what have you equals your net operating income, okay? And then equal monthly cash flow is a measly $32 monthly net cash flow. You're thinking, oh wow, the monthly cash flow is so low. No, I'm not gonna buy this. Wrong. This, I know cash flow is a little bit low. I understand that, but just bear that in mind. So let's go through the subsequent calculation beyond the first year, right? At least, hey, look, at least your rent is covering all your debt obligations. So that's a win, okay? It'll make the deal for you moving forward. Look at all the good stuff. Most investors, not especially newbies, even large experienced investors, they don't even look at the returns from year to year, year 1, year 2, year 3 to year 10 and beyond. Let me briefly share that with you. And Maureen, you and I went over this on our previous presentation a while back, but it bears repeating because this is so important. I know a lot of investors, you don't have the proper software, or some of you are not, are not mathematically inclined, but you don't have to be a math wizard to calculate this kind of numbers, right? So don't fear math. It's just simple calculation of math. But once again, you gotta, investors, you have to listen to this presentation more than once, right? The repetition is the mother of all learnings. All right, so therefore, let's look at the year 1 and year 10. Look at the amazing total return you're getting. Okay, and the projection I put down is 5% rental increase every year, right? It's just a projection, okay? No one can predict the future, okay? I don't have a crystal ball. And then our assumption, we're making 5% rental increase every year, and then 5% appreciation rate every year. So with this assumption already in place, let's look at from year 1 to year 2, look at the gross rent, right? If you increase gross rent 5%, which is in line with inflation, you see the rental gross rent increases year 1, year 2, year 3, year 4, so forth, and all the way year 10. Then you minus the vacancy losses, potentially 5% vacancy rate per year. Then you have the operating income right here. Now look at the expenses. Yeah, the taxes will increase little by little, just like insurance. You know, that's inflation, cost of living, whatever, those kind of things. So look at expenses. Gross rent minus expenses, right, equal whatever. Then the next category, the next category, let's talk about, let's categorize income analysis, right? So you have your rent minus your debt obligations equals net operating income. Then you minus the annual mortgage. By the way, yeah, your mortgage, as Maureen alluded to, is a 30-year fixed rate mortgage, which is amazing strategy, which is a hedge against inflation. We will talk more about that. So your mortgage payment will stay fixed, where everything else is variable expenses, including inflation. Then your cash flow, right, at the end of the first year, nothing to brag about. If you increase your rent 5% year over year for the next 10 years or more, you can see your cash flow will increase little by little, right? So if you stay patient, your cash flow will get better. So don't worry about that, right? So cash flow will create that deal, but the way you make money with real estate is multi-dimensional, and we are talking about it right now, right? Then your renter is gonna pay down your mortgage. So your renter is gonna pay down everything, not just the mortgage every month, right? So if you buy in a good market, a good rental market, good appreciation market, population growth, job growth, whatever, in this case with the market that Spartan Invest is doing, over time, you're going to achieve your goals. So principal reduction, right? Is it amazing, right? And your renter gonna pay down your mortgage, gonna pay down your little bit of your principal reduction as well over time. See, so you see this amazing trend that we're seeing. Then appreciation every year at a mere 5% appreciation. Year 1, your appreciation is already 11,500. But look, okay, at the end of the first year on the previous projection. In fact, let me go back to the previous notes. Look at the numbers. Now, at the end of the first year, 5% appreciation, 5% multiplied by 230,000. So your first year appreciation is around $11,000. Now, because of you using leverage, the power of using a loan, then the $11,000 of at the end of first year appreciation at 5% divided by your total down payment, which is your total investment of 61,000. Guess what? If you look at upper right hand corner, your total return on investment is more than 20%, much higher than the stock market, Bitcoin or crypto or mutual funds or whatever you have. Just at the end of the first year, the total return on investment at the end of the first year is more than 20%. Why? Because you use the power of leverage. When you use loan, when you use financing, your return on investment is higher. No other investment, no other asset class other than real estate, you can do leverage. When you buy a stock, you're buying dollar for dollar. When you buy for crypto, you're buying dollar for dollar. There's no financing, there's no leverage. So hard asset really beats other type of assets on a historical basis. Okay, that's a fact, Jack. Right.
That is a fact, Jack. I like it. Said with such enthusiasm and exclamation point at the end of that.
Yeah, there's a movie made by what's his name?
I wouldn't recall, but I know the line. That's a fact, Jack.
Yeah, Bill Murray made that movie, the military movie.
Stripes.
Stripes, great movie, great military comedy, 1991, 1980. Anyway.
We probably lost some of the millennials there, Seewing. You have no idea what we're talking about.
Yeah, I'm not a millennial. I'm a baby boomer. Okay, all right. All right, let's continue with this amazing numerical analysis. I digress. Getting back, okay, your cash flow is higher on an annual basis as you increase your rent, right? And then principal pay down, appreciation. See, every year with 5% appreciation, second year you could get 12 grand of equity appreciation. Third year at 5% growth, 12,679, and then eighth year, $17,000 appreciation that year, right? It just accumulated, compounding, the compounding effect of owning a real estate hard asset. And then finally, I think I'm done with that. In fact, there's more. My second slideshow, as we're heading into the category of loan analysis, right? Every year, your 230K purchase at the end of the first year increased to 241 at 5% appreciation. Second year, 253. You see the systematic increase of the market value of your property. Then your loan balance gonna increase year by year, and your poor renter is making you rich. All right, and there are plenty of them around that are begging to rent your place. Is that amazing? They are making renters, tenant are making you rich. All right, I mean, you as a landlord, you're making you just wow, you're just living the life. All right, your market value of your home systematically increase year by year from year 1 to year 10. Your loan balance decreases. What a great concept. Year to year, then equal your equity. Rising market value, hopefully, over time, decreasing loan balance will give you more equity year by year. At the end of the first year, only $71,000 of equity. But at the year 4th and 5th, look at how much equity you have gained, right? 117,000, 134,000. Then let's look at one of your potential many multiple exit strategies. I call it exit strategies. That's the power, right? When you build a portfolio of real estate, buy more than one rental, hopefully, right? Maureen and I, we encourage people to buy at least 10 properties, right? At least 10 properties in the next few years. Build up that portfolio, 10 properties, 1 to 4 units, for example, mainly 1 unit, single family home, the ideal. And then you just do it in a turnkey way, and then if you own 10 or 20 properties, guess how much time you spend managing your properties every month? 1 hour, maybe?
I'd say, yeah, maybe 1 or 2 hours a month. You're not really doing much other than looking at your statements.
Exactly. That's right. Okay. Anyway, then your loan to value ratio decreases because your rising market value minus, decreasing loan balance, right? See your loan to value, the year 4th and year 6 is at 50%. Guess what? At that time, if you want the ideal way to get more wealth, to accelerate your wealth, is to cash out, refinance the equity from your rental property to buy more rental properties. The year 4 to year 6, at 58% loan to value, you can refinance 20 grand to 30 grand. You can buy 1 or 2 more properties from this one rental by leveraging cash out refinance when the LTV is sufficient, right? So that's how you do your portfolio. You put your initial down payment, and then over time, the next few years, you can cash out refinance. By the way, when you do cash out refinance, it's a tax-free transaction, right? No tax implications. Another great aspect of owning a hard asset, you don't pay taxes. All right, and then let's look at the final numeric. I know it's much more than, I don't want to like spend too much time on number crunching. Sometimes it's kind of boring, but this is necessary for you to learn. Okay, I mean, investors need to be re-educated, and this 10-year projection is such a crucial aspect to learn for any investors out there, whether you're experienced or newbie. So the final category for the next few minutes is a sale analysis, right? So that's just the equity you have, right? Market value minus loan balance equal your equity for over the next 10 years. Then if you were to sell your property at some point in time, it's okay to sell your property down the road, right? But invest for the long term. If you, for whatever reason, if you need to sell at the 5th year or the 8th year, this is a potential gross profit, proceeds from the sale before closing costs and all that stuff, right? 113,000, 166,000, it's a nice chunk of money. So you're going to sell your property. If you're going to say you're done with risk investing, you don't want to become a landlord anymore, that's fine. Life happens, right? Whatever goals you have at that time, it's okay to sell and pay your capital gains tax of 20% or whatever the tax bracket at that time. You still have a good net profit after you pay the capital gains tax. If you sell, you still have a nice chunk of money that you earn by owning this investment asset over time. But then again, if you want to continue to be a landlord, you can sell your one or more rental properties at the 5th, 6th, or 7th year and not pay capital gains tax. You can do a 1031 tax deferred exchange, right? Again, I'm not a tax advisor. Marie's not a tax advisor. You need to consult your tax advisor or your financial advisor to go over your unique situation. I'm just giving you a disclaimer. But you do a 1031, then if you sell one of your investment property and you buy a replacement property, you can sell 1 or 2 single family home rentals, or and you can buy a fourplex, or a commercial unit or something like that, and the profit you make from the selling of the property to trigger the 1031 tax free exchange or tax defer. You don't pay taxes as long as you meet the requirement of a 1031 tax defer exchange. Is a subject for another topic. Many of our investors, Maureen and I, we have helped to do the 1031. So very, 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 very profitable. And one final thing, real estate investing is a generational wealth building. It's a generational wealth building scenario you can pass on to the next generation. Is that if you hold your rental property forever, right, and enjoy all the passive income and tax benefits and cash flow and appreciation, if you hold it forever until you pass, guess what? At the time of death, the asset will have a step up in basis. That means the value of your real estate properties are at the time of death is trigger a market value. So there are no tax consequences for your beneficiaries, right? So if you want to create a legacy for your children and grandchildren, into the next generation, right? The wealth building over time that you achieve at this time will have a legacy transfer for your for yourself and your loved ones, right? So and 2 more things, and we should be finished very shortly. And something Maureen talked about, I want you to talk a little bit more about it. The power of the 30-year fixed rate mortgage. I mean, it's just people take it for granted, right? I mean, a fixed rate mortgage as an investor is such a powerful strategy. It's a good debt. To me, it's an 8th wonder of the world. It's the greatest invention in the history of wealth building, and it will change the trajectory of one's financial future. And it's an inflation-induced debt destruction, right? So if you use good debt, if you leverage your investment property with a fixed rate mortgage, do it multiple times by buying multiple rental properties, it will change the legacy of your family's life generationally. So Maureen, let's talk a little bit more about the power of the 30-year fixed rate mortgage and why it's a hedge against inflation.
Yeah, So Seewing, well done. By the way, I love the analytics that you went over, because you really, the last two slides really illustrated the multiple ways that real estate pays you. And if we could just, I'll answer your question. If you could go back one slide. I want to highlight this because I think as investors are looking at and they're evaluating, let's say an investor was in their own little office of their home and they're looking at this spreadsheet, right? All these data points. And a lot of times if you can go see where it says the cash on cash return, right? If you want to kind of move your cursor to the cash on cash return up above the loan, up above the loan analysis right there, right? You see 0.4%, 1.4, 2.5, 3.6.
Right.
So think about the error that an investor would make if they are simply basing their investment decision off of the cash flow only, right? Think about it. If you have to, the way to build wealth, the way that you generate wealth is whatever your capital, whatever vehicle you place your capital, could be real estate, could be commercial real estate, mobile homes, multi-units, crypto, oil and gas, cannabis, I don't care what it is, right? The thing that you have to, as an investor, the way that you build wealth is your rate of return has to beat inflation. It just has to. Because if you've got, let's say you've got $200,000 sitting in an account earning 1% and inflation is 8.5%, the value of your 200,000 is decreasing every single day that you do not get that capital earning above inflation. Okay. Now, when you look at this cash on cash return, or maybe you're the investor that just looks at the dollar and cents. Like I'm a dollar and cents kind of gal. I want to see how much money is coming in per month, right? But if you were first time looking at a pro forma and and you've never bought an investment property before, and this is what you're looking at, you might just go, and you're only looking at year one, right? 0.4, not very exciting, right? Especially if inflation is 8.5%, which I think is underreported. I think it's higher than that. But you see year after year, now this is just the cash on cash return, right? You see year after year that cash on cash return goes from 0.4% past 11%. The same thing with your, let's see, I don't think you have it here on the rent. But when you are looking at making a decision on investing, if you just base your decision on the cash on cash return or just on the cash flow, the monthly cash flow per month, and you exclude, maybe accidentally, you don't really think about what is the appreciation of this asset over my holding period of, X a number of years, 5 to 30. What is the principal pay down benefit from a rate of return perspective over that 5 to 30 year period? What is my depreciation or my tax benefit year after year, for the 5 to 30 years that you're holding the property? That, when you get that big picture and you just get off that one little metric of the cash on cash return, and you look at it globally of what a real estate investing in a piece of property does for you long-term, you and your family long-term, that's when your mind opens up. And that's when you get to, you finally hear the messaging. Because I get it. A lot of times you guys could be tuning in and going, oh, they're just trying to sell us properties. No, we're trying to help you understand wealth building principles that will help you and your family get to where you want to go. It's not going to happen in the first 12 months with a rental property. But when you build a portfolio and you hold that portfolio or those numbers, that's number of properties for a period of time, you earn on appreciation of that asset. You earn on the rent increases that increase your cash flow. You earn on the amortization schedule on the principal buy down piece. You earn on the tax benefit that you get every single year. And you earn on the hedge against inflation, because as inflation increases, rents increase and the value of your property increases. I don't know any other asset class that offers that kind of level of protection against inflation.
Unbeknownst to you, Maureen, I'm just segueing into what you just said. Here it is. By the way, Maureen had no idea my slideshow. And it's just, you and I have such a good synergy. What Maureen just said is just such a powerful way to say it. And no other real estate guru out there other than Maureen and myself can give you this kind of perspective around risk investing. So with that said, what Maureen just said was income property and rental property is the history's most powerful and proven multi-dimensional real estate asset class. All right, let's digest this terminology for a second. I say it again, and Maureen, if this doesn't excite you, you guys out there, Maureen is excited, I'm excited. I want you to ingrain this terminology into your brain if you want to become a serious real estate investor. Let me repeat this again. An income property, a rental property you're purchasing, whether a single family home or duplex or triplex or fourplex, is history's most attractive, most powerful, most proven, and most tax efficient multi-dimensional real estate asset class. Why? Because you're getting a passive income, increasing cash flow over time, right? You get depreciation tax benefit, or your income from your property will be hopefully taxed at a much lower bracket because all the deduction expenses, your mortgage, your taxes, your insurance, your property management fee, are all a annual tax deduction against your gross income. Plus, you have other aspects of taxes like 1031 tax-free exchange, or when you pass, your property get a step up in value, so your beneficiary does not pay taxes. You get cost segregation, which we don't even have time to talk about. You get bonus depreciation, acceleration depreciation, which is all kind of great stuff. And then, of course, historical growth appreciation. Over time, your asset will appreciate and all that stuff. And finally, leverage. We talk about leverage, right? No other asset class will give you that. Leverage gives you a higher rate return, allow you to put a lot less money to buy an asset, which worth a lot more money. Let's talk about the magic of compound interest, Maureen. At the bottom, it says, why is power of compound called the eighth wonder of the world? Let's do simple math, okay? You don't have to be a mathematical genius to get this very simple concept. 72 divided by your appreciation rate equals the number of years your asset will double in value. Okay? Okay. Now let's do a sample calculation. Okay, the power of compound interest, according to Albert Einstein, is the eighth wonder of the world. Let's segue back to this case study, which we started from. $230,000 property that we went over. We gave it a very cautious, low, conservative 5% annual appreciation rate. So let's apply the rule of 72, the magic of compound interest. 72 divided by 5 equals 14 years. So this $230,000 property at 5% annual appreciation growth in about 14 years, so $230K will become $460,000 in value. Wait, there's more. I sound like an infomercial. Now, because you are a great long-term investor, if you have the perseverance and the discipline to keep this property beyond 14 years, what if you hold this property for 14 more years beyond the initial 14 years. Let's say you hold the property for 28 years. You applying the Rule 72, applying the magic of compound interest in 14 more years, your $460,000 property value will double to $920K. So in a mere 20 years, your 230K property with very conservative 5 or 6% appreciation rate equals almost $1 million. So with that in mind, I rest my case. So this presentation has taken longer than usual, but we have to spend the time to re-educate experienced investors and especially newbie investors. This, I do not believe, I could be wrong, Maureen, you tell me, what other real estate gurus, what other real estate coach other than you and I have taken our time to holistically, from a big picture, from a 20,000-foot level, explain to you guys the benefit of real estate investing in a way we just explained. I don't know, I've been doing this for more than 20 years. I have not seen any other financial real estate organization that have explained it exactly the way we just did. So that is my recap, Maureen. So I'll give you your takeaway and your recap for the final 1 minute, then we'll get done with this presentation. What are your thoughts?
My thoughts are this: I always valued the time that we get to spend together because you and I have always been very focused on providing the best content, the richest content that we can at the relevant time. And we are, we're in a time where real estate, when we're in a time where investors are trying to figure out where to place their capital, they just need a beacon, they need a voice, they need real hard evidence, not a sales pitch. They just need hard evidence, data points that support what we are on a cause and a mission for, and that is investing in real estate is investing in your family. It's investing in your financial future. It pays dividends. You may not be getting exactly what you want on the cash flow side right now in a rising interest rate environment, but look at the big picture, because when you put it all together, all the ways that real estate pays you, it is a tried and true, for centuries proven wealth building vehicle.
Well said, Maureen. There's nothing I need to add on this, and I really appreciate your time you provide. Maureen, you and I work well together. We have the same synergy, same philosophy, same business model almost, and I really value your time. Take time out of your day to share your wisdom and your thoughts and your powerful ways of explaining things. I really appreciate working with you together. Our company and yours have some great working relationship over the years. It's all about helping investors out there, you guys, right, to achieve your wealth in a way that will impact your financial future and control your financial destiny. Hopefully this presentation helped. Thank you for attending. Thank you, Maureen McCann from Spartan Invest. Good luck to everyone, and take action and change your financial legacy in the future. Thank you so much. Have a nice day. Bye-bye.
Bye.